Imagine a company that didn't exist 6 years ago, started by hedge fund traders mining cryptocurrency for their fantasy football league, and today stands at the center of a $6 trillion AI infrastructure revolution. A company that went from buying discounted graphics cards from bankrupt crypto miners to securing $55 billion in contracted revenue from some of the most powerful tech giants on the planet. This is the story of CoreWeave, and why analysts believe this stock could multiply your investment by 10 times before the end of this decade. But here's what they're not telling you about the risks hiding beneath those explosive growth numbers. Let's start with something that should make your jaw drop. In late January 2026, NVIDIA, the trillion-dollar king of AI chips, just invested $2 billion in CoreWeave at $87.20 per share. Now, NVIDIA doesn't throw around billions lightly. They're betting on CoreWeave to build over 5 gigawatts of AI data centers by 2030. To put that in perspective, 5 gigawatts is enough power to run millions of homes. This isn't just an investment. It's a strategic partnership that signals NVIDIA sees CoreWeave as absolutely critical to the future of AI infrastructure. And this isn't NVIDIA's first rodeo with CoreWeave. They already committed $6.3 billion last year to buy CoreWeave's unused computing capacity through 2032. Think about that. NVIDIA is essentially guaranteeing CoreWeave revenue whether they have customers or not. That's how confident they are in this company's future. But let's rewind and understand how we got here, because CoreWeave's origin story is honestly stranger than fiction. Back in 2017, some traders at a New York hedge fund decided to mine Ethereum for their fantasy football league. They bought NVIDIA graphics cards to do it, and the crypto crash of 2018 happened. Most miners went bankrupt. These guys, they saw opportunity where everyone else saw disaster. They started buying up discounted hardware from insolvent miners at fire sale prices. When artificial intelligence exploded onto the scene, they realized something profound. The same GPUs designed for crypto mining were perfect for training AI models. They pivoted completely, transformed from Atlantic Crypto Corporation into CoreWeave, and positioned themselves at exactly the right place at exactly the right time. Fast forward to March 2025. CoreWeave goes public on NASDAQ at $40 per share. Today, less than a year later, it's trading around $96. That's already a 140% return for early investors. The stock hit an all-time high of $187 in June 2025 before pulling back. But here's the kicker. Despite that pullback, CoreWeave's market cap still sits at roughly $50 billion, and 27 analysts covering this stock have a consensus buy rating with an average price target of $124. That's nearly 32% upside from current levels. Some analysts are even more bullish. Citizens Financial maintains a market outperform rating with a price target of $180. Deutsche Bank upgraded them to buy with a target of $140. These aren't small-time analysts making wild predictions. These are major financial institutions backing their forecasts with serious research. Now let's talk about the numbers that really matter. CoreWeave's revenue growth is nothing short of astronomical. In 2022, they generated just $16 million in revenue. $16 million. In 2024, that number exploded to $1.9 billion. That's not a typo. From $16 million to nearly $2 billion in just 2 years. For 2025, analysts expect revenue to hit $5.1 billion. By 2026, projections show revenue reaching $12 billion. By 2027, we're looking at $19 to $20 billion in revenue. And by 2029, some estimates put CoreWeave's revenue at $25.8 billion. That's a compound annual growth rate of well over 50% for the next several years. In an industry where 20% growth is considered strong, CoreWeave is growing at more than double that rate. But revenue is only part of the story. The real game changer is CoreWeave's contracted backlog. As of the third quarter of 2025, they had $55.6 billion in contracted revenue backlog. That's up from $30 billion in the second quarter and just $17 billion at the start of the year. This backlog represents future revenue from customers that's already locked in through multi-year contracts. Think about what that means. CoreWeave doesn't have to worry about finding customers or convincing companies to use their services. The demand is already there, signed, sealed, and contractually committed. This gives them a level of revenue visibility that most companies can only dream about. While CoreWeave generated about $1.4 billion per quarter in 2025, their contracted commitments extend over many years into the future. That gap between quarterly revenue and total backlog suggests a long runway of embedded growth even if they don't sign a single new customer. So who's behind this massive backlog? The biggest names in tech. Microsoft is CoreWeave's largest customer, accounting for roughly 35% of their revenue backlog. That's down from 85% at the beginning of 2024, which shows they're successfully diversifying. They've got a $22.4 billion deal with OpenAI to provide computing capacity for ChatGPT and other AI models. Meta Platforms signed a $14.2 billion deal with CoreWeave. They've secured 6 separate contracts with leading hyperscalers, those massive cloud computing providers that power the internet. And they're working with Google, NVIDIA directly, and dozens of other AI companies that need enormous amounts of computing power. These aren't speculative startups hoping to make it big. These are trillion-dollar companies that have already committed billions to CoreWeave because they literally cannot get the computing capacity they need anywhere else. Let's talk about the broader market opportunity because this is where things get truly mind-blowing. McKinsey, one of the most respected consulting firms in the world, projects that data centers will require $6.7 trillion in capital investments worldwide by 2030 to meet the demand for AI and traditional computing. Of that, $5.2 trillion will be specifically for AI-ready data center infrastructure. The AI data center market is expected to grow from $236 billion in 2025 to $934 billion by 2030. That's a compound annual growth rate of 31.6%. McKinsey forecasts that global data center capacity could nearly triple by 2030, with about 70% of that demand coming from AI workloads. We're talking about demand growing from 82 gigawatts in 2025 to 219 gigawatts by 2030. AI-specific capacity is projected to increase 3.5 times, from 44 gigawatts to 156 gigawatts. Here's another staggering statistic. In 2025, major tech companies spent a combined $437 billion on AI infrastructure. Hyperscaler capital expenditures are projected to jump 40% in early 2026. Microsoft alone dedicated $80 billion in fiscal year 2025 to data center expansion. Amazon allocated $86 billion for AI infrastructure. This is the largest infrastructure build-out in computing history. Industry experts say it requires building twice the data center capacity produced since the year 2000, but in less than a quarter of the time. The demand is so intense that some data centers are reaching rack densities of 130 kilowatts, potentially hitting 250 kilowatts by 2030. For context, traditional data centers operated at around 40 kilowatts just a few years ago. What makes CoreWeave different from traditional cloud providers like Amazon Web Services or Google Cloud? CoreWeave is what's called a neocloud, purpose-built specifically for AI workloads. Traditional cloud providers were designed for general computing, websites, databases, and storage. They've had to retrofit their infrastructure for AI, which is inefficient and expensive. CoreWeave built everything from the ground up for AI. They claim their dedicated GPUs enable them to process AI tasks roughly 35 times faster and 80% cheaper than larger, more diversified cloud platforms. That's a massive competitive advantage. They're not trying to be everything to everyone. They're laser focused on being the absolute best at AI infrastructure, and that specialization is paying off in a big way. CoreWeave currently operates 41 data centers across the United States and Europe. At the end of 2022, they had just 3. In the third quarter of 2025 alone, they added 8 new data centers. They ended that quarter with nearly 590 megawatts of active power capacity and 2.9 gigawatts of total contracted power. They're on track to deliver over 800 to 1,000 megawatts of active power by the end of 2026. Every megawatt of capacity they bring online generates approximately $1 billion in annual revenue. So when they're talking about adding hundreds of megawatts, we're talking about billions in additional revenue potential. Their expansion isn't random. They're strategically building in Pennsylvania, Scotland, and partnering with the UK government for international growth. They're even working on self-build projects to gain greater operational control and reduce dependency on third-party developers. Now let's talk about the path to 10 times returns that's got everyone excited. CoreWeave's current market cap is around $50 billion. Analysts expect revenue to reach $19 to $20 billion by 2027. If CoreWeave trades at even 5 times sales, a relatively conservative multiple for a high-growth tech infrastructure company, that would put the market cap at $95 to $100 billion. That's already doubling from current levels. But here's where the 10 times projection comes from. By 2030, if CoreWeave achieves $46 billion in revenue, which is possible based on their current backlog and growth trajectory, and trades at a 9 times price-to-sales ratio, that puts the market cap at $414 billion. That's nearly 10 times the current valuation. Even if you use more conservative assumptions, maybe $30 billion in revenue and a 6 times multiple, you're still looking at $180 billion in market cap, or more than 3 times today's value. The bull case is incredibly compelling. CoreWeave has first-mover advantage in AI-specific cloud infrastructure. They have deep strategic partnerships with NVIDIA, securing access to the latest chips before competitors. Their contracted backlog provides unprecedented revenue visibility. The total addressable market is growing at over 30% annually for the rest of the decade. They're achieving gross margins above 60%, which is exceptional for infrastructure. And major institutional investors like Fidelity, BlackRock, and Jane Street have taken significant positions. When sophisticated investors with billions under management are betting big, that's usually a good sign. The economics of CoreWeave's business model are powerful. They spend heavily up front to build data centers and buy GPUs, but then rent that capacity out for years. GPUs have a useful life of several years, during which CoreWeave can continually rent them out at premium rates. As they scale up operations, their gross margins should expand while operating expenses decline as a percentage of revenue. But, and this is critical, we need to talk about the risks. Because for every compelling reason to invest in CoreWeave, there's a legitimate concern that could derail the entire thesis. Let's start with the elephant in the room. Debt. As of the third quarter, 2025, CoreWeave had roughly $31 billion in total borrowings. That's an astronomical amount of debt. In Q3 alone, their interest expense hit $311 million, up from $104 million in the same period the previous year. Through the first 9 months of 2025, interest expense totaled $841 million, roughly quadruple the amount from the same period in 2024. Think about that. They're spending close to $1 billion a year just on interest payments, and their net loss for the quarter was $110 million. Even with revenue over $1 billion, the company is burning through cash to fund expansion. CoreWeave is taking a massive bet that AI demand will continue growing and that their customers will actually pay for all that contracted capacity. They're borrowing billions today to build infrastructure that won't generate full revenue for years. If anything disrupts that timeline, if customers delay projects, if AI adoption slows, if there's a recession, CoreWeave could find itself in serious financial trouble. Their debt-to-equity ratio sits around 2.66. That's high leverage even for a capital-intensive business. Some analysts are calling this circular financing. NVIDIA invests in CoreWeave. CoreWeave uses that money to buy NVIDIA chips. NVIDIA's revenue goes up, their stock goes up, CoreWeave looks more valuable, and the cycle continues. But what happens if that music stops? There are also concerns about a class action lawsuit filed against CoreWeave, alleging misstatements about capacity and supplier risk. The lead plaintiff deadline is March 13, 2026. While lawsuits are common for public companies, this one raises questions about whether management has been fully transparent about operational challenges. Customer concentration is another risk. Even though it's improved, Microsoft still represents about 35% of CoreWeave's backlog. If Microsoft decides to build their own infrastructure or switches to a competitor, that's a massive revenue hit. CoreWeave is supply constrained, but not in the way you might think. They're not limited by GPUs. They're limited by powered shell data centers, partially completed facilities where they can install their equipment. In their third quarter earnings call, CEO Mike Intrator revealed that a third-party data center developer fell behind schedule, which forced them to lower their full year 2025 revenue guidance from $5.3 billion to $5.1 billion. A single developer being late cost them $150 million in revenue. Now imagine if multiple developers face delays, or if there are problems securing power, which is becoming increasingly difficult as data centers compete with residential and commercial users for limited electrical grid capacity. Then there's the technology risk. AI hardware depreciates at 20 to 30% annually. These GPUs that cost millions of dollars today could be obsolete in a few years if new chip architectures emerge. CoreWeave is betting on NVIDIA's roadmap, deploying the Blackwell chips now and planning for the Rubin platform in the future. But what if a competitor develops something dramatically better and cheaper? What if software optimizations make it possible to run AI models on less powerful hardware? The entire premise of needing massive GPU clusters could shift. There's also competition heating up. Amazon Web Services, Google Cloud, and Microsoft Azure are all pouring hundreds of billions into their own AI infrastructure. They have deeper pockets than CoreWeave. They have existing customer relationships. They can bundle AI services with other cloud offerings. Oracle is building massive AI campuses. Applied Digital is securing huge contracts. Nebius Group is expanding rapidly. CoreWeave isn't the only game in town, and their competitors aren't standing still. Valuation is another concern. At around $50 billion market cap and $5 billion in 2025 revenue, CoreWeave trades at 10 times sales. That's expensive by traditional standards. If growth disappoints, if margins compress, if the market decides AI infrastructure isn't worth premium multiples, the stock could get hammered. We've already seen it drop from $187 to below $90. That's a 50% decline in less than a year. Volatility is real with this stock, and investors need strong stomachs. Regulatory risks are also emerging. As AI data centers consume more power and water for cooling, governments are starting to pay attention. Environmental regulations could increase costs. Restrictions on power usage could limit expansion. Trade restrictions could impact where CoreWeave can build internationally. These factors are largely outside the company's control, but could significantly impact operations. Let's talk about capital expenditures, because the numbers are staggering. CoreWeave spent $12 to $14 billion on CapEx in 2025. For 2026, they're guiding for CapEx to be well in excess of double that amount. We're talking about $25 to $30 billion or more. Where is that money coming from? Some from operations, but they're not generating enough cash flow yet to self-fund that level of spending. They'll need to raise more debt, issue more equity, or both. Each option has downsides. More debt means higher interest costs and more financial risk. Issuing equity dilutes existing shareholders. There's a real question about whether CoreWeave can actually finance the build-out they're planning without fundamentally changing the investment thesis. One more critical point about the 10 times projection. It assumes perfect execution. It assumes CoreWeave hits revenue targets, maintains margins, avoids major operational problems, successfully raises capital, retains key customers, and that the overall AI market continues growing at current rates for the next 4 to 5 years. That's a lot of assumptions. In reality, things rarely go exactly according to plan, especially for a company scaling this aggressively. Even small misses on quarterly targets have caused the stock to drop 10 to 20% in a single day. This is not a stable, predictable investment. It's high risk, high reward. So what's the bottom line here? CoreWeave represents one of the purest plays on the AI infrastructure boom. If AI adoption continues accelerating, if companies keep spending hundreds of billions on compute capacity, if CoreWeave executes flawlessly, this stock absolutely could deliver 10 times returns by 2030. The fundamentals are there. Massive revenue growth, enormous contracted backlog, strategic partnerships with NVIDIA and the biggest tech companies in the world, first mover advantage in a specialized niche. The total addressable market is measured in trillions of dollars. The demand is real and growing exponentially. But this is not a safe investment. The debt load is concerning. The dependence on continued AI hype is risky. Execution challenges are mounting. Competition is intensifying. And the valuation leaves little room for error. If anything goes wrong, if there's a slowdown in AI spending, if they face major operational setbacks, this stock could easily drop 50% or more from current levels. Here's what serious investors need to understand. CoreWeave is essentially a leveraged bet on the continuation of the AI revolution. If you believe we're in the early innings of a decade-long transformation, where artificial intelligence reshapes every industry and creates insatiable demand for computing power, CoreWeave is positioned to capture enormous value. Their business model, their partnerships, their specialization all point to massive growth potential. But if you have any doubts about whether AI will live up to the hype, if you think we might be in a bubble, if you're concerned about economic headwinds or the sustainability of current spending levels, CoreWeave carries substantial downside risk. The stock has already demonstrated it can lose half its value in a matter of months. That volatility isn't going away anytime soon. The most important thing is to do your own research. Don't just take analyst price targets at face value. Read CoreWeave's quarterly earnings reports, understand their debt structure, follow news about their major customers, pay attention to what Microsoft, Meta, and OpenAI are doing with their AI strategies. Watch for any signs that the AI infrastructure spending cycle is slowing down. Look at what competitors are doing. And critically, only invest money you can afford to lose. This is a high-risk, high-reward stock. It's appropriate for the speculative portion of a portfolio, not for your retirement savings or emergency fund. If you're comfortable with significant volatility and believe in the long-term AI thesis, CoreWeave offers compelling upside. Just go in with eyes wide open about the risks. Now, let's dig deeper into what makes this opportunity different from the countless other AI stocks flooding the market. CoreWeave isn't trying to build the next ChatGPT or develop autonomous vehicles or create AI-powered software. They're selling picks and shovels in the AI gold rush, and historically, that's often been the safer bet. During the California gold rush of 1849, most prospectors went broke searching for gold. But the companies selling shovels, picks, tents, and supplies, they made fortunes. CoreWeave is providing the essential infrastructure that every AI company needs, whether it's OpenAI training GPT models, Meta building Llama, Google developing Gemini, or thousands of startups building AI applications. They all need massive computing power. And CoreWeave is one of the few companies that can deliver it at the scale and speed required. The infrastructure CoreWeave is building has another critical advantage: stickiness. Once a company builds their AI models on CoreWeave's platform, switching costs are enormous. You can't just pick up your training data and move it to a different provider without massive disruption, time, and expense. This creates powerful customer retention dynamics. That's why we're seeing multi-year, multi-billion-dollar contracts. These aren't month-to-month arrangements. Companies are making decade-long commitments because they need certainty that the infrastructure will be there as they scale. CoreWeave's average contract length is multiple years, creating predictable revenue streams that compound over time. Let's also talk about the timing of this investment opportunity. We're still in the early stages of the AI revolution. ChatGPT only launched in November 2022. That's barely over 3 years ago. The explosive growth in AI applications, from code generation to content creation to scientific research, is just getting started. Industry experts predict that by 2030, AI will be embedded in virtually every aspect of business and daily life. The compute requirements to power all of that are almost unfathomable. Current estimates suggest we'll need to build data center capacity equivalent to everything built in the last 2 decades, but compressed into just the next 5 years. CoreWeave is positioning itself at the center of that transformation. Consider the broader technological trends driving this. Large language models are getting bigger and more complex. GPT-4 was trained on an estimated 25,000 NVIDIA A100 GPUs for 90 days. The next generation of models will require even more compute. But it's not just training. Inference, the actual use of these models to generate responses, is becoming the dominant workload. Every time someone uses ChatGPT, every time an AI analyzes an image, every time a recommendation engine runs, that requires compute power. And inference demand grows with usage, not just with model development. As AI becomes more prevalent, inference workloads are projected to make up 75% of all AI compute needs by 2030. That creates persistent, recurring demand for infrastructure. There's also the geographic expansion opportunity. CoreWeave currently focuses primarily on the United States and Europe, but AI is a global phenomenon. Asia, Latin America, the Middle East, all these regions will need AI infrastructure. CoreWeave's partnership with the UK government for facilities in Scotland shows their thinking internationally. Each new geography they enter represents billions in additional market opportunity. The company has already demonstrated they can successfully deploy data centers across different regions with varying regulatory environments and power infrastructures. That operational expertise becomes more valuable as they expand. Let's discuss the competitive moat CoreWeave is building. It's not just about having GPUs, it's about the entire ecosystem. CoreWeave has developed proprietary software called Mission Control that optimizes workload scheduling and resource allocation. The software makes their infrastructure more efficient than competitors. They've built Sunk, their AI native software stack, which NVIDIA is considering integrating into their reference architectures for cloud partners. If that happens, CoreWeave's software could become an industry standard, creating network effects that make their platform even more valuable. They've developed deep technical expertise in cooling systems, power management, and data center operations, specifically optimized for the unique demands of AI workloads. This knowledge is hard to replicate and gives them an edge in efficiency and reliability. The partnership with NVIDIA goes far beyond just buying chips. CoreWeave gets early access to NVIDIA's roadmap. They're deploying the Rubin platform, the next generation after Blackwell. Before most competitors even know what's coming, they're integrating NVIDIA's Vera CPUs and Bluefield storage systems. This deep integration creates technical advantages in performance and efficiency. When you're competing for billion-dollar contracts with hyperscalers who demand the absolute best performance, these technical edges matter enormously. CoreWeave can offer better price-performance ratios than traditional cloud providers precisely because their infrastructure is purpose-built and cutting-edge. Now let's address a question many investors have. How does CoreWeave's valuation compare to peers and historical precedents? At 10 times sales, it seems expensive, but context matters. Amazon Web Services, in its high-growth phase, traded at similar multiples. Snowflake, the cloud data platform, has traded at over 20 times sales during growth periods. The key is whether the growth justifies the multiple. If CoreWeave can maintain revenue growth above 50% for the next 3 years while expanding margins, a 10 times sales multiple is actually reasonable, especially when you consider that much of their future revenue is already contracted. This isn't speculative growth based on hope. It's growth backed by signed contracts worth $55 billion. There's also the question of timing your entry. CoreWeave stock has been volatile, ranging from $33 to $187 in less than a year. Some investors might wait for a pullback, but timing the market is notoriously difficult. The stock could easily run to $150 or higher on positive news before pulling back. Alternatively, it could drop to $70 on any hint of operational issues. Dollar cost averaging, buying shares incrementally over time, might be a smarter approach than trying to perfectly time a single entry point. That strategy reduces the risk of buying at a temporary peak while ensuring you participate in the upside if the stock continues climbing. It's worth examining CoreWeave's management team and their track record. Michael Intrater, the co-founder and CEO, has been with the company since its crypto mining days. He's navigated massive pivots and scaled the business from essentially zero to billions in revenue in just a few years. That's impressive execution. The CFO, Nitin Agrawal, previously held senior finance roles at major corporations and brings institutional financial discipline. The board includes experienced technology executives and investors who understand infrastructure businesses. Leadership matters, especially for a company trying to execute such an ambitious growth plan. So far, management has generally delivered on what they've promised, though there have been some hiccups like the third-party developer delays. Let's also consider the broader economic environment and how it affects CoreWeave's prospects. We're potentially heading into a period of economic uncertainty in 2026 and beyond. Typically, infrastructure spending is more resilient during downturns than consumer spending. Companies might cut marketing budgets or delay new product launches, but if they're in the middle of building critical AI capabilities, they can't just stop spending on infrastructure. The long-term contracts CoreWeave has in place provide some insulation from economic cycles. However, if there's a severe recession, some customers might try to renegotiate terms or delay capacity expansions. The extent to which CoreWeave's revenue is truly recession-proof remains to be tested. Interest rates are another factor. CoreWeave's massive debt load means they're sensitive to interest rate changes. If rates rise significantly, their interest expenses increase, further pressuring profitability. Conversely, if rates fall, it could ease their debt burden and improve their financial position. The company has been working to secure better lending terms as they grow and become more established, which helps mitigate this risk, but it's something investors need to monitor closely. Any significant change in the interest rate environment could materially impact CoreWeave's financial outlook. Let's talk about potential catalysts that could drive the stock higher. Quarterly earnings reports showing continued revenue growth and margin expansion would be positive. Announcements of new major customer contracts would validate the growth story. Successfully bringing large amounts of new capacity online on schedule would demonstrate operational excellence. Raising additional capital on favorable terms would ease concerns about their ability to fund expansion. Achieving profitability sooner than expected would change the narrative from growth story to profitable, scalable business. Any of these developments could trigger significant stock appreciation. On the flip side, negative catalysts include missing revenue guidance, delays in bringing capacity online, losing a major customer, or having to raise capital on dilutive terms. There's also the possibility of acquisition. CoreWeave's $50 billion market cap is large, but not impossibly large for a tech giant. Could Microsoft, Google, or Amazon decide to acquire CoreWeave rather than build competing infrastructure? It's possible, though regulatory scrutiny of big tech acquisitions makes it complicated. Such a deal would likely come at a significant premium to current prices, potentially offering investors a liquidity event and substantial gains. However, CoreWeave seems focused on remaining independent and building a long-term standalone business. Management and investors like NVIDIA probably see more value in CoreWeave continuing to grow than in being absorbed by a larger company. Let's discuss the sustainability angle, which is becoming increasingly important. Data centers consume enormous amounts of electricity and water for cooling. As environmental concerns grow, there's pressure to use renewable energy and reduce water consumption. CoreWeave has made commitments to sustainable operations and is exploring advanced cooling technologies that reduce energy and water usage. They're working on power purchase agreements for renewable energy to reduce their carbon footprint. Companies signing major contracts increasingly care about the environmental impact of their infrastructure partners. CoreWeave's ability to operate efficiently and sustainably could become a competitive advantage. Conversely, if they face environmental opposition to new data center sites or struggle to secure green energy, it could slow expansion. For investors considering CoreWeave, portfolio allocation is crucial. This shouldn't be your entire investment portfolio. It's not even appropriate as a large portion of your stock holdings unless you have very high risk tolerance. A reasonable approach might be allocating 2 to 5% of your equity portfolio to CoreWeave, enough to benefit meaningfully if it succeeds, but not so much that a total loss would be devastating. Pair it with more stable investments. Balance high risk, high reward plays like CoreWeave with dividend paying blue chips, broad market index funds, and bonds. Diversification is your friend, especially when investing in volatile growth stocks. Finally, let's talk about what success actually looks like. If CoreWeave achieves the 10 times return scenario, hitting a $400 billion market cap by 2030, they would be one of the most valuable technology infrastructure companies in the world. They would be in the same league as companies like Oracle, approaching the size of companies like Meta. That's an extraordinary outcome for a company that barely existed a few years ago. We've seen rapid ascents before. Amazon went from an online bookstore to one of the most valuable companies on earth. Netflix went from DVD rentals to streaming dominance. CoreWeave is attempting something similarly ambitious in AI infrastructure. The ultimate question for investors is simple. Do you believe artificial intelligence will transform the global economy over the next decade? Do you believe the demand for AI compute will continue growing exponentially? Do you believe CoreWeave has the partnerships, technology, and execution capability to capture a significant share of that market? If you answer yes to all three questions, CoreWeave represents a compelling investment opportunity despite the risks. If you have doubts about any of those premises, the risk-reward profile becomes less attractive. One final thought. The $2 billion NVIDIA just invested at $87.20 per share is telling. NVIDIA wouldn't be putting their capital and reputation on the line if they didn't genuinely believe in CoreWeave's future. Jensen Huang, NVIDIA's CEO, called this the largest infrastructure build-out in human history and said CoreWeave's deep AI factory expertise and execution velocity are recognized across the industry. That's high praise from someone who understands this space better than almost anyone. At the same time, Huang also acknowledged that the $2 billion represents just a small percentage of the total funding CoreWeave will need to raise. Even NVIDIA, with all their cash, isn't willing to fund the entire expansion. That should tell you something about the capital intensity and risk involved. CoreWeave is racing toward a future where AI infrastructure could be worth hundreds of billions or even trillions of dollars. Whether they reach that destination as a dominant player worth 10 times today's value, or stumble under the weight of their debt and operational challenges, remains to be seen. The next few years will be absolutely critical. They need to execute flawlessly on bringing capacity online, maintain and grow their customer relationships, manage their debt effectively, and navigate an increasingly competitive landscape. The margin for error is slim, but the potential rewards are enormous. For investors willing to accept the risk and volatility, CoreWeave offers one of the most direct ways to participate in the AI infrastructure boom. For those who prefer stability and predictability, there are safer places to put your money. The choice is yours, but make it with full awareness of both the extraordinary upside potential and the very real downside risks. This is not financial advice, but rather an in-depth look at one of the most fascinating and potentially lucrative investment opportunities in the rapidly evolving world of artificial intelligence. Do your own research, understand your risk tolerance, and invest accordingly.